$4,346 gold price surge ignites global market jitters. You know that feeling when the entire financial world suddenly pivots around a single headline? That's exactly what happened this week when gold hit a record-breaking $4,346 an ounce. That's right, $4,300 for 1 ounce of gold. Incredible, isn't it? And the reason behind it? A more dovish stance from the U.S. Federal Reserve that has the markets buzzing and investors flocking back to safe haven assets. Welcome back to Impact Solutions podcast, where we break down the latest in business and financial news so you can make sense of what's happening and why it matters. I'm your host, and today we're talking about the shiny yellow metal that everyone's suddenly obsessed with again, gold, and how a softer tone from the Fed has turned the market upside down. So, let's start with what set this off. The Federal Reserve's latest comments signaled that they're leaning toward more interest rate cuts in the coming months. After maintaining a high-rate environment for most of the past 2 years to combat inflation, the Fed seems ready to shift gear. That simple hint, that rates might go lower, was enough to ignite a rush into gold. Gold rose by 1% just this week, while silver rebounded 2%, reversing some of the losses both metals saw earlier in the year. What's fascinating here is not just the numbers, but why it's happening. Lower interest rates generally make non-yielding assets like gold more attractive. Simply put, when yields from bonds or cash deposits fall, investors look for assets that can store value without relying on interest. Gold, historically, fills that role perfectly. But there's also a psychological angle here. When central banks turn dovish, it often signals uncertainty. Maybe growth is slowing or inflation risks are easing. And when investors aren't sure where the economy's heading, they look for safety. Gold becomes the refuge, the old reliable. Let's unpack this a little more. Over the last decade, gold has had several spikes, but each time, the stories behind those jumps were tied to global uncertainty. Think back to 2020, during the height of the pandemic, gold breached the $2,000 level for the first time then. Fast forward to now, 2025, and we're more than double that number. Inflation fears, lingering recession risks, currency volatility. All those themes are back on the table. Another important factor is international buying. Central banks worldwide, especially in Asia, have been increasing their gold reserves steadily. China and India, two of the largest consumers of gold, have also seen higher retail demand this festival season, which is playing into the momentum. This combination of institutional and retail buying pressure is creating the perfect storm for prices to climb higher. Now, some analysts are arguing that we might be witnessing an overextended rally, that the $4,346 mark could represent a short-term top. Others disagree, saying this may just be the beginning of a new supercycle driven by global liquidity, geopolitical tensions, and continued uncertainty about the dollar's long-term strength. Let's look at the Fed again, because they're right at the center of this. In their last statement, Chair Jerome Powell used the word confidence a few too many times, as in confidence that inflation is moving sustainably toward our target. Markets interpreted that as, we think inflation is cooling enough to safely lower rates. And once traders sensed that direction, the floodgates opened. Interest rate futures are now pricing in at least 2 more cuts for next year, and those expectations are pushing the dollar down. A weaker dollar means gold, which is priced in dollars, becomes cheaper for buyers in other currencies. So, not only do you have lower yields driving demand, you also have currency dynamics adding fuel to the fire. And here's another layer, silver. Silver tends to move alongside gold, but it's more volatile because it also has industrial uses. So, when silver rebounded 2% this week, that told us something interesting. Investors are not only seeking safety, but are also betting on economic resilience, since silver benefits from industrial demand too. Let's pause for a second and put this into perspective. If you had bought gold at the start of the decade, when it hovered around $1,500 an ounce, your investment would have nearly tripled by now. That's a phenomenal run for an asset often considered boring. But it also raises an important question. How sustainable is this rally? Markets move in cycles, and gold's history shows that rapid surges are often followed by long consolidations. It might also be worth watching how other markets respond. Equities have been steady but cautious. The S&P 500 dipped slightly after the Fed's comments, suggesting that investors are still digesting what this new monetary environment means for risk assets. The bond market, meanwhile, has rallied, which reinforces the idea that investors are preparing for lower rates and less yield competition with metals. From a broader economic standpoint, this could change the investment landscape for 2026. If the Fed continues cutting, we might see more capital flow into commodities and tangible assets. Not just gold, but also silver, copper, and even real estate, as investors look to hedge against any future monetary or geopolitical shocks. So, where does this leave you and me as observers and participants in the market? Personally, I see this as a moment to stay curious and cautious. Gold at $4,300 is newsworthy, but it's also a reminder that markets run on emotion as much as logic. Greed, fear, and hope often move prices faster than fundamentals do. Before I wrap up, I'll leave you with this thought. Do you believe we've entered a new era for gold? One where safe haven demand defines the next few years? Or are we simply witnessing another speculative bubble that could burst as quickly as it began? I'd love to hear your take. Share your thoughts in the comments. I always enjoy reading different perspectives. And as always, thanks for tuning in to L Impact Solutions podcast. Stay informed, stay curious, and I'll catch you in the next episode.